This little piece of metal recently crossed $80 an ounce, but recent prices have been dropping. By the end of this video, you'll understand the real mechanics behind silver and whether we are at the start of a silver crash or if this is a buying opportunity before the next bull run. Before we dig into whether 2026 represents an opportunity or risk, please hit subscribe if you like these breakdowns and if you find them useful. It takes a lot of time to put them together and I appreciate your support. In December 2025, silver crossed $80 an ounce. January 1980, when it briefly spiked to roughly $50 during one of the most infamous market manias in history. But the circumstances in 1980 were much different than they are today. The story goes like this. In 1979, three brothers known as the Hunt brothers attempted to take over the silver market. Their simple plan was to buy up more than 100 million ounces of silver, so much silver that they could essentially control 1/3 of the silver supply that regular people could buy. Silver shot up from around $6 an ounce to nearly $50 an ounce in just over a year, 713% surge in the price of silver. To put that into perspective, we ran the numbers through our inflation calculator at How Cash Works, and that 1980 silver price comes out to about $200 an ounce today. So how did the Hunt brothers have so much money? The Hunt brothers already had massive money before they ever touched the silver market. Their wealth came from oil. Their father was one of the richest oil men in the United States. But the Hunt brothers borrowed heavily to finance their silver purchases, using what's called margin. Margin just means they didn't pay the full price for the silver. They put a small amount of cash and borrowed the rest to control way more silver than they could actually afford. On January 7th, 1980, COMEX, a major futures exchange, introduced Silver Rule 7, which changed the rules. The Hunt brothers were buying so much silver on margin that it was starting to break the market. As a result, silver prices dropped over 50% in 4 days. Silver essentially crashed. On March 27, 1980, also known as Silver Thursday, they faced a $100 million margin call they couldn't pay, with potential losses reaching $1.7 billion. Thankfully, a group of banks provided a $1.1 billion bailout. And by 1982, silver had fallen 90% to $4.90 an ounce. Now, for the record, 1980 wasn't the only time silver spiked. It happened again in 2011. After the 2008 financial crisis, the Federal Reserve went into emergency mode. Interest rates dropped to zero. They started printing money through quantitative easing. The dollar weakened. Does that sound familiar? Silver went on a tear. It climbed from $8.50 an ounce to nearly $50 an ounce by April 2011. That's almost a 500% gain in about 3 years. People thought that was it. Silver is finally breaking out. Some predicted $100, some $200. Then the CME stepped in with a margin hike. Basically, that means they increased the amount of collateral required to open or maintain a position. Just like in 1980, they raised margin requirements, not once, 5 times in 9 days. The result? Silver crashed nearly 30% in a matter of weeks. It dropped from 50 to 35 just in 5 trading days. Leveraged traders got wiped out. The rally was over. What killed silver in 2011 wasn't a change in fundamentals. Demand was still there. The money printing didn't stop. What killed it was the same thing that killed it in 1980. Regulators pulled the rug out from under leveraged speculators. So now we have 2 historical examples, 1980, 2011, where silver ran to 50 and got smacked down by margin hikes. Now let's step away from history and look at what's happening today with silver. Silver prices are up over 150% in a year, which is unusual for a commodity. At the same time, the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has moved from above 100 in early 2025 to 55 to 60 today. According to the World Silver Survey 2025, published by the Silver Institute, the silver market has begun running a structural supply deficit for 5 straight years. In simple terms, the world has been using more silver than it produces every single year since 2020. If you strip everything else away, silver prices in 2026 are being pushed by 2 forces at the same time. The first is real demand. Silver just isn't being traded, it's being used. Solar panels, electric vehicles, power grids, semiconductors, and infrastructure behind AI all require silver. The second force is money itself. Over time, countries print more money. When that happens, each dollar buys a little less. Prices adjust upwards, savings lose purchasing power, and holding cash quietly works against you. When these 2 forces overlap, rising industrial use and weakening currency, silver prices can remain high. At the same time, mining takes years to expand, not weeks. To really understand if silver is overpriced or an opportunity, let's look at the numbers driving silver demand. Solar alone consumed almost 200 million ounces of silver in 2024, and this trend isn't slowing down, with targets like EU aiming for 700 gigawatts of solar capacity by 2030. Electric vehicles also need silver. A recent report forecasts that EV vehicles will be the primary source of automotive silver demand by 2027 and account for 59% of the market by 2031. AI and data centers are also a huge part of this story. Every time you ask ChatGPT a question, stream a show, or upload a file to the cloud, that action gets processed inside a data center somewhere. These aren't small server rooms. They're massive, always-on facilities packed wall-to-wall with machines running non-stop. And they're scaling fast. Global data center power capacity has increased more than 50 times since the year 2000. According to the International Energy Agency that powers demand, it's expected to double again by the end of this year. And that means more silver getting locked into infrastructure. As I mentioned earlier, supply of silver can't just ramp up overnight. About 72% of silver doesn't even come from silver mines. It's a byproduct of mining other metals like lead, zinc, copper, and even gold. So even if prices spike, miners can't just flip a switch and produce more. There's a physical squeeze happening right now in silver. Inventories on the Shanghai Futures Exchange have collapsed 86% from their peak in 2020. COMEX vaults in the US saw over 60% of their registered silver claimed for delivery in December alone. In addition to that, in January of this year, China implemented a new export restriction on refined silver, choking the supply for solar and AI global industries around the world. So how high could silver go? Some analysts are predicting as high as $150 an ounce by the end of this year. Bank of America is at $65. So as you can see, there are various opinions. Other analysts say they wouldn't be surprised to see it around $100 by the end of the year. If you're thinking about going long on silver, it's just as important to understand what can go wrong as it is to understand what's driving demand. If industrial demand collapses due to a global slowdown, silver's price floor could drop significantly. Silver fell over 50% during the 2008 crisis. If the cost of silver goes up too much, in fact, it could be a headwind for tech stocks, some of which rely heavily on silver. High prices also push companies to look for alternatives. Manufacturers may try to reduce the amount of silver used per product or explore substitutes like copper or aluminum. All right, let's answer the question. Should you buy silver in 2026 when it's near all-time highs? First, we need to know how silver trades. Silver does not trade like normal commodities day to day. It trades like leveraged financial assets and a physical metal second. Short-term price is driven by paper markets. Most silver trading volume happens in futures and ETFs, not physical bars exchanging hand to hand. When traders reduce risk, silver gets hit fast. When silver runs hard, it attracts leverage. When price stalls or dips, margin traders unwind. That creates drops that have nothing to do with fundamentals. After a 150% move, silver was crowded. It doesn't need bad news to fall. It just needs less buying pressure for a few days and weeks. Another thing we need to ask ourselves is if for 5 years silver demand exceeded supply, why did prices stay flat? And many argue it's because there were buffers, stockpiles, warehouses, inventories, and ETF holdings. The system had cushion. But recently, I mentioned silver inventories have collapsed from their 2020 peak. The buffers are dwindling, the reservoirs are low. Silver didn't move because demand went up. Demand was already there. Silver moved because available silver might finally be scarce. Here's how I'm thinking about it, and this is not financial advice. Silver has real structural demand now. Solar, EVs, AI, data centers, that's not going away. There seems to be a physical squeeze happening right now with inventories at record lows. And cash sitting in savings is losing every single day to inflation. Now, does this mean silver is guaranteed to go up? No, it's volatile. It could drop another 20% and shake out a lot of people. That's just how silver works. But here's what I'm doing. I'm not stockpiling silver coins. I know that stackers out there might disagree, but I prefer the quick liquidity of an ETF like the iShares Silver Trust, ticker symbol SLV. I'm slowly dollar cost averaging into a small position within my portfolio. Now, in essence, it's not the traditional paper silver that we hear about. SLV is a trust designed to hold physical silver and issues shares that represent a fractional interest in that silver. Current data shows they hold over 517 million ounces of silver. Now, does this mean as a shareholder I can walk in and grab a few bars of silver? Absolutely not. Only big players can do that, otherwise known as authorized participants. But for me, with silver recently dropping from all-time highs, I started to move some money out of a few of my riskier positions and into silver. Not because I'm predicting some moonshot, but when I looked at my portfolio, I asked myself, what has a chance of working out better? Some of my speculative bets have not hit their targets, and silver is pushing towards 100. So everything we just talked about, for me, silver looked like a higher probability play. Now that's not advice, that's just how the math looked from where I'm sitting. So let's zoom out. The pattern is simple, and it's played out again and again. Governments create more money, cash quietly loses value, real assets tend to do better over time. Silver just happens to be sitting in a rare spot right now. On one side, it's a critical industrial metal tied directly to the biggest build out we've ever seen. Solar, electric vehicles, power infrastructure, data centers, AI. None of that works without silver. On the other side, it's still a monetary metal. When trust in the system weakens, people don't run to promises, they run to things that exist. Silver is volatile. It will shake people out. It always does. But when you look underneath the price action, the setup itself looks good to me. That's not a prediction. It's not advice. It's just how I'm thinking about it. If this breakdown helped you see the bigger picture, please hit subscribe. No hype, just understanding how cash works.